Hello, the Oak Bloke here, and this is covering one of my book 25 for 25, which is XLPE, which is an ETF that tracks private equity. So the ETF is this one, X Trackers. I'm not connected to this company or any of the companies I ever talk about. This is not advice. This is just my personal opinion. But the point of this article is to look at and cover. So these are the holdings. So as you can see here, it's covering across these securities are the listed holdings that are held by the companies that are in this ETF. The holdings themselves are these. So you've got 3i Group, EQT, Ares Capital, and so on, and more moving down. So this is actually tracking the top 25 by market capitalization private equity companies. So in this article, which hasn't been released yet, and you're the first to see this, what I'm doing is I'm looking at basically the reason I chose this in the first place was the inevitable, what I see as the inevitable increase. You have to forgive me, I've got the sun sort of beaming in at me at an angle, so I'll go over here and it's out of my eyes. Yeah, it's looking at the what I see as the inevitable value being created by private equity, and private equity is always a long-term strategy. And if you're a high net worth individual, then perhaps yes, you can access private equity directly and you can invest into it. If you're not a high net worth individual, and obviously and even if you are and you sort of say, well, I want to keep my options, this is a way that you can invest in private equity, but it's listed on a stock market. So you are sort of, accessing private equity without actually investing in private equity and tying up your money for long periods of time. What you're instead doing is buying into the companies that are managing those funds. And again, the approach of private equity, private credit, and real estate and infrastructure is that these are long-term themes. So it's investing in the guy that's actually doing that investing and earning fees from doing that investing that you're profiting from. That's the thinking here. And obviously what we're interested in therefore is how successful they are in achieving that. How many more fees are they earning? How are they growing those fees? How is that market improving? So it's not actually the gains and losses directly, it's the ability to do the deals and to earn the fees ultimately that drives the share price of this share. It doesn't pay any dividends. It's purely an accumulating ETF that tracks the top 25 private equity holdings. Anyway, I went in quite large on this, and it was an interesting thought. And my thought process was that I knew when I chose this idea that Trump was going to be president. We knew the election result, didn't know anything about tariffs beyond a vague, mention of that being his preferred form of tax. So yeah, tariff Liberation Day and tariffs in 2025 has caught quite a lot of people on the I suppose on the hoof a little bit, and that's an evolving picture, and it's I mean, I'm recording this on the 25th of August, and it's still an evolving picture. But when you look at the 2Q25 results, private equity is just continuing to do its thing. It's not seen a catastrophic um, fall off because of Lib Day. I mean, has it held up deal flow? Yes. Has it been disruptive? Yes. Has it fundamentally changed the picture? No. It's just paused things. Is kind of the feedback from various people. And in this article, so I just talk about, the ETF comes with a cost. So you're paying 0.7% to access the 25 top companies. So you may or may not think that's a good idea. I think that's good value for money personally, but you may have another opinion on that. So far, it's not delivered any result. It's actually lost money. It's lost 1.9%, which of course considering the Lib Day disruption, I guess you could say, well, actually, that's not a terrible result, but it's not an amazing result either. I mean, it's if you'd bought at the lows, which were just after Lib Day, you'd be well into profit on this. As I average, personally speaking, I average down. But what I'm basing that 1.9 is, from the date that I released the idea um, in late 2024, judging it on its performance in 2025, that's kind of what we're interested in doing. But I think there's a distinction I would draw between what's happening with the share price, that, and the results in the 2Q. So 2Q being April to June 2025. What are those results actually looking like? Let's kind of dive into that. So before we do, what I've done is I've collected together, and this isn't scientific, but I'm taking some of the leading minds, leading analysts, so the likes of PricewaterhouseCoopers, Goldman Sachs, and so on, Ernst and Young. So just to kind of say, what are those guys saying about private equity? And so in case of PricewaterhouseCoopers, there's continued strong appetite for deal making despite volatility. Profitable businesses with solid fundamentals and compelling tailwinds continue to attract interest, but deal makers are showing greater selectivity and at times opting to pause. So they speak of the uncertainty in the US environment, and yeah, there's work going on to plug vulnerability. So that's things like supply chain disruption, and that's not a new theme. I mean, we've had that now for numerous years, but that's a focus of private equity, according to PwC. Ernst and Young, they point to the 3-year high that happened in 1H25. Now that's actually, despite Lib Day, more deals were done in 1H25 than in the last 3 years. So since 2022. And obviously, there was a very large spike of activity in 2021, and some of that continued in 2022. But then, things went seriously south for private equity in 2023 and 2024. Deals fell off a cliff. And these are hyperlinks, so you can go in and read. There's some nice charts and graphs. I haven't uh, reproduced any of those here. I've just taken some of their commentary whilst crediting it back to those publications. And yeah, there's significant exit transactions, deals totaling $308 billion in 1H25. The most in a while. M&G speak to resilience in uncertain times, that private markets have not been immune, that the current elevated levels of uncertainty and apprehension is unhelpful. However, it's at times like this that long-term patient capital, and of course that's what private equity is, that's when private equity actually isn't subject to the same pressures as public markets. Public markets, obviously, where stock markets, share prices go up and down every day. And of course, if the stock price goes down, then you're under pressure to take action. With private markets, you kind of have a shelter from that to some extent. The idea of having to release 4 quarterly updates to the market, you're not under that same pressure with private markets. Of course, you've got to turn a profit ultimately, but you can kind of act in a more long-term way potentially. I'm not saying it always happens that way. I'd say private equity is focused on achieving something like a 3-year outcome. So it's like a 3-year plan or a 5-year plan. Quite often, they uh, and also will engage in debt, perhaps more so than public markets, because in public markets, that becomes much more visible very quickly. But ultimately, it's about private equity dressing up companies, improving companies, so that they can achieve an exit. And an exit is either an IPO, and of course IPOs have also been at record levels in 1H25 in the US, not so much in the UK or elsewhere, but certainly in the US, we've seen a strong deal flow of IPOs in 1H25. So again, uh, the narrative and the commentary and the outlook is very different to the 1.9% drop in the share price of XLPE. So M&G also talk about yeah, just recovery and recovery in real estate, the ongoing need for private credit. And this is an important point to talk about actually, is whilst the ETF is called private equity, the, the 25 firms that it holds, private equity is only a component of what they actually are operating in. I mean, I would say XLPE is something like approximately 30% private equity, and then 30%, maybe 35% private credit. So this is lending that is being done not via a bank or not via the banking system. The banks have pulled back from lending to businesses. This is a PE house lending to a business, lending funds to a business and earning interest, earning returns on that loan. And that's a very large growth area. I mean, and that's probably larger than the private equity component. There's then infrastructure, so that's investing into everything from airports to roads to electrical power grid infrastructure, through to solar, through to all sorts of infrastructure investment, bridges and hospitals and all sorts. And then finally, real estate is the fourth component of this. And again, that's somewhere 10 to 20% of the holding. So when you're sort of investing in private equity, kind of it's not really that, or not exclusively that. I think that's another factor here, is that what you're actually lending into, or what you're investing into here, is a portfolio, like a 60/40 portfolio in many ways. So it's an interesting perspective. I mean, don't allow the name of the ETF to, because very often, I mean, I've commented on this in other articles, very often these ETFs will say, that what it says on the tin is not what's inside the tin, or at least not wholly what's inside the tin. There was a good example recently where somebody said, "Oh, I'm investing into silver miners ETF." There was a silver mine SILG, I think it was, and I sort of looked at it and I analysed the holding. And I said, "Well, you do realise that this is, I think it's about 38% silver and 40 something percent gold. So your silver miners ETF is more gold than it is silver, and then it had some copper and lead and other things, because very often, just reality of silver, I guess, that silver is a byproduct of other metals. I mine for zinc, and in and amongst my zinc, I get a byproduct of silver. So that's the same here, essentially, is that the minority is private equity, not the majority. Moving on to Goldman Sachs, pressures exist, uncertainty exists, market volatility hindered deal making, shifting focus to a rebound in the second half, reduced activities driving demand for liquidity, so in other words, into private credit. Valuations on balance are elevated. Now, that's a positive sign. Elevated valuations indicates a stronger market. So that again is as far as I'm concerned, a positive. There is a potential for a harder for longer environment that could extend holding periods, and that's a negative. There is of course pressure on private equity to um, to do deals, to recycle capital, to achieve, ultimately you achieve returns, not just paper returns, but actual returns by doing deals. So, I suppose the conclusion that Goldman Sachs comes to is that there's a complex environment where there's opportunities, and where, again, private equity is structurally set up to to um, to succeed and to drive through value. Those with value creation skills and disciplined deployment strategies are well positioned to navigate these conditions. So, you know, choosing the top 25 firms that are doing that seems like a good idea to me. So moving on, 3i. So this is at a massive, or large premium to its assets. So if you bought 3i, which of course you would be buying 3i indirectly through XLPE, you've got to be happy that paying that premium is worth it. By the way, All of the other firms, if further down the list, if we look at those are at a premium to their assets as well. It's not an exclusive characteristic of 3i to be at a premium. The premium reflects the fact that it's able to deliver value, is able to invest into assets that they themselves grow. And look at how Action grew in the 3 months, including the Lib Day tariff, so on, disruption. So they grew the valuation from 17.8 to 19.2 billion euros. Very good, very good outcome as far as that goes. But also others, this 3i infrastructure. So this is a listed holding that grew 10% or about 7-8%. Royal Sanders that grew about 5%. So it's growing. It is able to grow other holdings other than just Action. It's not a one-trick pony. But yeah, I think the ongoing ability to drive value um, makes this seem like a good share. And I'm a bit more relaxed than I suppose other people, because what you've got to also think about is, well, if it can continue to do what it's doing for the next 3 years, it's not going to be on a premium, it's going to be on a discount. So at that point, the share price will have gone up to reflect that it's continuing to drive value. So I think you've just got to kind of make your own decision on that. And like when you look at the performance of Action year on year as well, so its sales have increased by what, a sixth in a year. It's I mean, the sales growth there percentage wise is dropping in the period, compared to last year, but that number to that number, I mean, that's a 1/6 growth. Bit to margin, 13.7, strong margin, new stores added, and so on. So there's lots of reasons to feel pretty happy about 3i. Moving to EQT, so this is the second largest holding, so it's got 8.7 of 8.7% of XLPE is EQT. Now, watch out, because there's several EQTs out there. There's one that's listed in the UK that is a very small nano cap that I've written about, and I wasn't very complimentary about it, and it's gone down in share price since I wrote about it being a bit of a basket case. It's fallen about 10-15%. That's a sort of technology to convert waste materials into biogas, supposedly. So that's not this EQT. There's then an EQT in the US, listed in the US, which is an oil and gas, or mainly natural gas producer. That's not this. This one's a Swedish company. So EQT.se. So Stockholm is listed, and yeah, this has increased its assets under management year on year. Its deal making has, it's managed to achieve some improvements to exits. You can see the difference between last year and this year. Tripled. So some really good results there, and yeah, has if you consider it over 6 years, I mean, it's grown itself by about 6 times. So pretty impressive numbers. Now, EQT are involved in Japan very heavily. There's I could talk for probably an hour about just about Japan, but quick version of that is that there's about 4,000 companies listed in Japan. Many of them basically are below, a discount to their book value, so they hold, potentially 50, 60, 70, 80, 90, 100, more than 100% of their share price in cash or in assets that you could just, you could asset strip, you could buy the company, asset strip it, sell the actual business and make a vast profit. And that's what they're doing. They're engaged in activism to yeah, just to stir up and to realize value. And that's an ongoing theme that the Japanese stock market itself is trying to encourage, because there's this kind of sleepy mentality of well, let's keep cash. It's kind of the equivalent of let's keep cash under the mattress of a just in case something bad happens. But of course, the downside of keeping vast amounts of cash under the mattress is that, well, you're not making that cash work for you. That cash is just sitting there, not benefiting the economy. And yeah, why shouldn't that money be returned to the owners of the business, the shareholders? And that's essentially what EQT are doing, is activism to realize value, and also more than that. I mean, it's other things going on in Japan, like cross holdings, so businesses own each other, and therefore nobody can force them to change, because they're all in a sort of little club where they own each other, so nobody's got the power to force them to make any decisions. They can essentially, they're not answerable to shareholders, because the shareholders are a group of companies that they also own. So that practice is being broken up and altered. And there's the threat of delisting, the threat of fines, different measures that the Japanese stock market, the topics, have taken and are taking. So yeah, one of the large deals was taking out Fuji Tech, which was a large top four elevator maker. Um, vast amounts of recurring income, as you can imagine. Once somebody's bought your elevator, well, they're going to pay to maintain it for the next however many years that elevator is in operation. And Fujitech was trading at a 60% discount to its assets, and EQT took it out at a 9% discount to its assets, and that was just the book value of its assets. So EQT sees 100 billion further funds being added to its portfolio, and that, of course, would add serious amounts of firepower to what is today 1.5 1.5 billion, sorry, 1.5 trillion. So another 100 billion is kind of what they're seeing, and they are investing into a wide range of things. Kind of what I've said already, that it's not just about private equity, it's about investing into real estate, private credit, and infrastructure. Moving on to Aries Capital, number three. So this one grew. Now, there's two Aries. Aries Capital is a company that focuses on private credit. It achieved a 10% total return in the 12 months to June 2025, which again I think is a pretty strong result, considering it's not been the nicest and smoothest 12 months to June 2025. Some of that was a dividend, and some of that was the NAV increase. Okay, so the NAV increase being a smaller component. But yeah, very strong results through a difficult period. As I say, this is predominantly private credit, not wholly, 10% private equity, but very much focused into software, health, professional services. I think I list those there, so you can have a little look at that if you want to. And majority of their private credit is what's called first lien senior secured loans. So senior secured means it's secured on assets. First lien means you get first dibs. So this is kind of like preferential loans, or you are first in the pecking order. So into that you should read lower risk. And they also talk about suffering very few losses on loans that have gone bad. Aries management, moving on to that. So this is second Aries. This is much more focused onto private equity, and you can see here assets under management grew from 447 to 572 year to year, which again, superb result, considering it wasn't the easiest. um, 12 months. Earnings per share increased from 0.43 to 0.46. Now, whilst assets under management grew to 572, only 349 of that is actually fee paying. In other words, they will take assets, and then it's only when they deploy them that they start charging fees. So there's a sort of a hiatus, or a moment where you know there's unearned, there's money that they're holding that they've not deployed, and because they've not deployed it, they're not charging fees on it. So in other words, when you sort of consider that there's, well, therefore 220 billion of follow-on funds that are one day going to be earning fees, well, obviously that earnings per share, um, is going to go up, even if it's just the deployment of those funds. So again, I kind of estimated that to be a 15% boost to fee income, which would translate to something like a 50% increase to EBITDA. So in terms of earnings per share, I mean, whether that would all feed through, but certainly a good percentage of it would feed through to the bottom line. And we can see that happening even in June 2025. So some really good results as far as I could see. Partners, this one's Swiss, so again it's a Swiss private equity, reporting in US dollars, but based in Switzerland. So they grew their assets under management to 174 across their 5 strategies. Again, it's looking at real estate, and interesting with these guys, royalties is another source of income. So they're actually buying pharmaceutical royalties and then earning income from those. So again, that's something that you might not expect to see within private equity, but that's another stream of income that they also engage in. So you can sort of see here, it grew from 152 to 174, so about a 15% increase to assets under management. Um, Therefore, and they do talk about a difficult environment, and that tariff uncertainty impacted things for them. You can see here the exit environment, as far as they were concerned, is down somewhat year on year, but sort of broadly comparable with the past 3 years. So that's been their experience. But even so, they've managed to grow assets under management. And these are just some of the examples of the private equity firms that they are investing into, and also the royalties that they're investing into. So just if I sort of zoom that in a little bit, so you can sort of see, this one, humanization of pets. It's these are the actions that they're taking. And this one's power transition, so it's battery energy storage. So they adding battery energy storage to gas production plants, which I've never heard of before, which I thought was actually quite interesting, and different things. So you get a sort of bit of a flavour of the sorts of companies that they are backing in their private equity. So leading on now to sixth one, KKR. So these guys do a lot of focus into insurance. They've got a large insurance. So again, not necessarily something you would expect to see, or you would assume to see in a private equity ETF, but that's a large component part of KKR. Obviously, the asset management is the private equity, private credit, strategic holdings. So it's kind of a little bit of I suppose, the difference between this one and this one. These are where they're using their own capital to actually own businesses. So this is where they are buying businesses where they're using other people's capital to buy the businesses, whereas this is where they're using their own capital and they own the businesses directly. So there's a little bit of a mixture of 3 different pots or 3 different strategies. They earned 118 per share, which was up 10% year on year. Their fee related earnings grew, as you can see there, even just quarter to quarter, which I took to be a real positive. So even though they had Lib Day and Trump tariffs to contend with, they were able to increase their operating earnings and fee related earnings in the second quarter. The long-term picture on this is very positive, as you can see here. Now this is the makeup of their, so you can see liquid strategies, which I think is money market. Alternative credit is private credit. So this is making loans to businesses. Leveraged credit, as opposed to alternative credit, I believe these is all just 2 forms of private credit. Real estate, obviously, is real estate, housing, property. infrastructure and energy is infrastructure, and then growth equity and core private equity is obviously investing into businesses, private equity. And then you've got again, two flavors or traditional private equity here. So you can sort of see, 200 and something billion of 686 billion is private equity, and the rest of it isn't. So that's just an example of where, whilst it says private equity on the tin, inside the tin it's actually quite different. But that percentage there should make you feel quite warm and fuzzy inside. Potentially 18% compounded annual growth rate since 2010. And even here within like the last couple of years, when private equity's been in the doldrums, uh yeah, they've still managed to grow it, what, 30, about 30%, 35% since 2022. So I think to a certain extent, you've got to sort of take, the doom and gloom headlines with a little bit of a pinch of salt. So anyway, concluding, so yes, this has gone down 1.9% in the 8 months to where we are today. Will it leap up in the final 4 months? I can't guarantee that. I'm not going to try, and none of this is advice anyway. This is just me kind of seeing it as I say it and saying it as I see it. And what I'm seeing is very strong underlying performance at these 6 of the 25, but this is the largest 6, and it's about half of the ETF. So it seems to me that this remains a very good idea. It's if anything, the share price is cheap relative to how it's performing. That the share price will at some point catch up with how it's performing, in my opinion. And yes, Lib Day caused a swerve, and it obviously, because the companies went down based on Lib Day, but much of the stock market went down on Lib Day, that there's been a big bounce back since, and obviously the bounce back here has not been sort of wholly able to erase the loss, but I kind of expect that it will over the course of the coming months. And it's that sort of compound annual growth rate of 18%, 20%, and that's what I'm seeing across these 25 holdings, is that they're just able to trundle onwards, delivering value, and the ups and downs of the public stock markets are kind of, I mean, the boom and bust of those. Yes, yes, obviously they are going to fundamentally follow the macro environment of public markets, but they're also sort of able to dance their own tune and look at the long term. So I kind of like the fact that it offsets what is, like the rest of my portfolio is largely public equity. To have something into private equity and into private credit and real estate and infrastructure, like I say, this is kind of like a 60-40 type approach, really, because you're not just buying private equity. So yeah, I kind of feel that and I think the final thing I would say is, whilst we're seeing a lot of companies in the UK getting bought out by private equity, um, there's people that say, "Oh, let's work out who's going to get taken out next. Let's invest into them because they'll get taken out at a 30% premium or a 20% premium, or whatever." That's great, and yes, that's a way to potentially make money. Although you have to guess which company is going to be that one, and there's no way of knowing as far as I'm concerned. I mean, yes, there's potential for getting taken out, but there's no guarantee of that. Um, I think the more interesting idea is, well, the guy that's doing the buying, I mean, they are obviously sort of, it's like going to a flea market and, you sort of see a battered old book and, like, somebody selling it at a fiver, and you kind of go, oh, and you're in as soon as you sort of show some interest in that book, a load of other people come along to the flea market and go, oh, I'll give you 6 quid, I'll give you 8 quid, I'll give you 10 quid. You know, that's why that example of the Fuji lifts, it got taken out at a 9% discount, because obviously other bidders will come along and sort of counterbid and potentially counterbid, and you don't get to buy it at a 60% discount. But the fact that they're buying it at a 9% discount, and are happy to do that, tells you that, the book value, or the net value, it doesn't just stop at a 9% gain. That, what they're seeing is that, well, okay, if we do this, this, and this, if we relist it in the US, if we expand it, if we change this part of it, if we get rid of the costly management overhead, whatever it is that the private equity are going to do to add value, if we, introduce these synergies, that they can then repackage it and sell it off. And it's, to me, it's like buying up that first edition, that battered old book at the flea market. Is like, it's because, like, I know my first edition books of I don't know, Enid Blyton. So, like, I spot a first edition Enid Blyton, and I know that I can sell that, uh, in Sotheby's for £1,000. So the fact that I've got outbid by all these people kind of going £5, £10, £15, who cares? The bigger prize is to take that first edition, you know, maybe sort of do a bit of restoration with a guy with white gloves, and I don't know what they do to make first editions look more attractive to Sotheby's, but there's got to be something like that, I'd imagine. Um, or maybe there isn't. Maybe they just take the battered book and sell it. Who knows? But that's the kind of, for me, the more interesting thing here is that it's not about finding the companies that get taken out. It's being part of that story of the companies that are taking the takeout and then doing something with those companies. To me, that's the more interesting idea and story, and that's going on at a big pace in the UK. We see it every day, every week. It's I think one commentator said, oh, who's the daily, which company is going to be the daily takeout today? And it's like a daily occurrence almost. Apart from on Fridays, they were joking. 4 times a week we're getting a company taken out, and I think that's true. But I think the more interesting is, like, who's doing the taking out, because they're the guys that know about Enid Blytons and first editions. Anyway, that's enough from me. That's the idea. This will get published in the next couple of days. I think, yeah, this sort of last bit here, it's not just about the US market. Whilst a lot of the companies are listed in the US, they are themselves investing all across the world. They've got offices across the world. They're investing across the world. So it's about sort of, just chasing global capital across this idea. Anyway, that's enough from me. Oakbloke signing off. Cheerio for now. Cheery.